What does the Fed intend to do about its balance sheet? Let's get more insight from Joel Prakken, Senior Managing Director at Macroeconomic Advisors, who joins me in studio today, typically in St. Louis, right?
Here I am. Thanks for having me back.
So the market has priced in another interest rate increase, but the question that everyone's curious about is, will there be any kind of telegraphing at the conference tomorrow about when and how the Fed is going to continue to make its balance sheet a little smaller?
I expect so, but let's first return to the issue of the rate hike. The Fed's been looking for opportunities to raise the federal funds rate, economy permitting. Inflation has been a bit soft, but labor markets continue to tighten, and I think that's going to allow the Fed to raise rates tomorrow as priced in. Much more interesting will be any communications about paving the way to begin gradually phasing down the Fed's balance sheet, probably sometime later this year. What will the process be? What will the pace be? What will the limits on the monthly runoffs be allowed to be as we go forward in time?
Yeah, and I mean, is there any way of sort of guessing that in a little bit in advance? The Fed and individual members did say that all of this would be telegraphed very, very well to markets, that there would be no risk of any kind of roiling of markets.
It's certainly the case that they want to avoid roiling markets. One way to do that, of course, is to announce well in advance what you're going to do. And I think a second part of that strategy will be to end the phase out very, very gradually, putting limits initially on the monthly amounts of the balance sheet that can run off that are very predictable and won't be exceeded or undershot.
Let's have a quick look into my Bloomberg, because chart 765, that's G hashtag BTV space 765, shows the Fed balance sheet and how it's all, made up of Treasury bonds and notes for the most part, a little amount of tips, and then you've got agency MBS. They have said that they're going to reduce agency MBS and regular Treasuries roughly at the same sort of time anyway.
Well, there's a lot more uncertainty, we think, about the pace at which the MBSs will be allowed to run off. There are prepayment risks that depend on interest rate pass, but we do know that the Fed would like to get out of the MBS market because it would like to not have an active presence in mortgage securities themselves. The Treasury part, I think, is a lot easier. The Treasury financing schedule is well known. The QSIPs are well known that the Fed is holding, and the rate at which they're going to run off is very easy to predict.
So what will it do to bond markets? Maybe not tomorrow, but coming towards the fall. And do we also get another interest rate increase this year?
We're looking for 3 rate hikes this year. We've already had one. We'll have another this week, something later this year. In terms of the runoff of the balance sheet, our estimate is that as the balance sheet declines, the so-called term premium, which is the gap between forward expectations of short-term interest rates and Treasury yields, will gradually increase. So this is just another way of removing monetary accommodation and letting interest rates rise.
So, Joel, you talked about inflation a little bit. I mean, we're still stuck at the 1.5% rate
Yes.
for PCE, and, the Fed talks about transitory inflation and so on. What will bring inflation up?
Well, let's first talk about the very recent moves in inflation. This spring, there was a very notable slowing in core PCE inflation, but a lot of that can be traced to a sharp drop in the price of wireless services that occurred mostly in March, but through the spring. This was a result of the Bureau of Labor Statistics applying a so-called large quality adjustment to the price of those services to allow for the fact that one of the major carriers introduced unlimited data plans that proved very, very popular with their consumers. Putting that special effect aside, we think that tightening labor markets, inflation expectations still anchored at 2 above the current rate, okay, and the fact that oil prices are starting to move up and the dollar's rise has stopped and the disinflationary effects from that are probably waning now. All of those things probably will allow core inflation to gradually move up, reaching the Fed's 2% objective in late 2018, maybe in 2019.
What would you ask Fed Chair Janet Yellen tomorrow?
Well, I think there's an interesting question of musical chairs at the FOMC. The president has nominated 2 persons to fill the missing spots in the FOMC. If they are a fact appointed, the FOMC will be at full strength. But there's an interesting dilemma. Chairman Yellen and Vice Chairs Fisher's terms as chair and vice chair expire before their terms as regular governors. So should they choose to remain on the FOMC, the next chair and vice chair will have to come from that group of 7. Makes for an interesting guessing game.
Well, right, but we talk about the idea of Randy Quarles potentially being the next Fed chair, and other names have been put out there as well. Who do you imagine it might be?
I don't imagine. Who do you imagine it might be?
Well, I'm just asking questions, so I don't know, but it does present
I don't have the answer to that, but one of the things that I think is interesting is several of these appointees have expressed a public support for the idea that monetary policy might be better run if it followed a mathematical algorithm, some kind of Taylor rule, for example, rather than discretion. So we're looking to see whether these appointments sort of change the way in which Fed addresses monetary policy or communicates monetary policy to markets.
Of course. Charles Plosser was on this morning saying that the Taylor rule was basically dead. We've also had, in the last... Well, he's been saying this already, but today, again, Bill Gross talking about all asset markets are too highly priced. What is the outlook for monetary policy for the next Fed chair? I mean, if asset prices are too high, and I'm not saying they are, that's just one man's opinion, but if they are, and the Fed is raising rates and the Taylor rule is dead, I mean, are all textbooks to be thrown out?
Well, the Fed doesn't explicitly target asset prices. They only react to the impact of changes in asset prices on the dual objectives of high employment and inflation. So my sense is that as long as the economy cooperates with their forecast of steady, slightly above trend growth, with inflation rising towards the objective and unemployment rate close to full employment, they're going to look for opportunities to gradually raise the target funds rate and proceed with the gradual reduction of the Fed's balance sheets. To me, their two biggest challenges over the next 3 or 4 years could be these. First, the recovery is a little long in the tooth, and the probabilities are that when the unemployment rate is this low, that within a few years, we could be looking at a recessionary episode. And the second big uncertainty is, what are the administration's fiscal policies going to be? Are we going to have tax cuts? Are we going to have regulatory reform? Are we going to have healthcare reform? How will they affect the Fed's outlook for unemployment and inflation, and hence indirectly their approach to setting monetary policy?
Can I get a 10-year yield forecast for the end of the year?
263.
Oh, wow, seriously?
Yes.
Okay, that's a major move higher, 50 basis points and a little bit less at the moment. Joel Prakken, Senior Managing Director.